Dr. Evans, Dr. Richard Evans, is the founder and general manager of SSR Health and the author of Health and Capital, and has done a lot of great work, and they have a lot of great data on prescription drug prices and PBMs, and I'm super excited to hear from him. And this kind of also marks a transition in the conference from focusing on medical services to pharma. And I think Dr. Evans has a great presentation for us. So thank you. Please give him a warm welcome.
All right. Thanks, Teddy. Hi, everybody. What I wanted to do is just talk about the relationship between brand manufacturers and PBMs. So I'm going to skip the relationship between PBMs and generics and PBMs and pharmacies, whether it's retail or specialty. I'm doing that in the interest of time and to stay within my expertise, but it's important to remember to really understand the PBM industry. You'd obviously want to spend some time understanding how they relate to generics and to pharmacy as well. But we're going to stick with the brand relationship. We're going to cover this. We're going to set this in motion beginning kind of back when PBM started and then just carry it through to the current day, because each of these individual eras kind of add up to the current situation. So the first thing I want to talk about, chapter 1, we call it Dialing for Dollars. It's kind of 1984 to 1993. PBMs were around in the 1960s, but they didn't really do a lot. They didn't really start getting their elbows out until the formation of Medco in 1984. And the business model was really pretty simple, and it honestly was not that powerful. Think just industrial scale call centers, literally warehouses full of people with headsets, making outgoing calls, trying to capture a written prescription and switch it to something else. Most of these things are being filled at retail, so it's fast moving. You don't have a lot of time to switch the prescription. And importantly, it's a two-tiered formulary world, or even a one-tiered formulary, right? So you'd come in with a Pravachol prescription and your plan wants you on Zocor, and Pravachol is going to cost you $20 or Zocor is going to cost you $20. As a patient, you don't care, right? You just want to get your prescription and go home. You've got no skin in the game. So you heard pharmacists saying things to patients like, would you like to save your plan some money? Well, of course not. I just want what my physician wrote. So it wasn't a terribly effective business model. It got a little more effective when mail order became part of the mix, right? Because it just slows the prescription down. It gives the PBM more time to work with it, and it gets you a higher switch rate, but it still didn't matter that much unless you were a company that really had your business centered in antihypertensives or ulcer. And those categories were getting affected, not dramatically, but enough to make manufacturers take note. And so at the helm of Medco, you've got Marty Wygod, great salesman, whatever else you might say about him, Isaac Schulman, great pricing person, Per Lofberg, great operations person, and a lot of very energetic investment bankers take us to chapter 2, which is the acquisition, the vertical acquisition of Medco by Merck. So Merck buys Medco in 1993. Very quickly, Lilly follows and buys PCS, and SmithKline Beecham buys DPS in 1994. And the core motivation, you don't have to work real hard to understand, right? If I own the PBM, I can give my brand's preference within that PBM, as simple as that. The other thing I gain is I can see my competitors' prices, because when Roche comes to Medco to bid, Merck gets to see the price that I'm offering to Medco, which I'm also offering when I compete with them at DPS and PCS. So really core, simple advantages. But there was another sort of strategic motive that I think gets lost to history, and that deals with capitation. So remember, during this time period, managed care is really just starting, right? And we're trying to figure out, is the drug benefit going to be part of the plan? Is it going to be carved in? Is it going to be carved out? If it's carved out, who's taking the risk? Is it the payer? Is it the plan? Is it the PBM? Is it the manufacturer? There was a non-trivial chance that risk was going to flow down to the manufacturer. So one of the elements of logic, I think from Merck's perspective, is the following. So if an individual pharmaceutical company is going to offer to cover risk, right, to capitate drug consumption, let's say you've got a population that consumes on average $100 per member per month, just for easy math, and Merck manufactures 10% of the basket. Their cost of delivering that capitated commitment is the $90 worth of stuff they have to buy on the open market and the $10 worth of stuff that they make, but they make that stuff at 15 cents on the dollar. So their cost of satisfying that capitated commitment is $91.50. If they raise their market share, keeping everything else equal, to about 15%, then their cost of meeting that capitated commitment is $87.25. So whoever has the largest market share, if you can control the rest of the basket, owning a PBM, you are the low-cost provider of a capitated contract. So had that world come about, it really would have put Merck in a very powerful position relative to the smaller manufacturers. The world did not come about, as we all know. Almost 5 years to the day after Merck buys Medco, they signed a letter with the FTC saying that they will not show brand preference to their own brands within Medco. That essentially kills the strategic utility of PBMs to manufacturers, and it ends the vertical integration era. So Merck builds a Chinese wall in 98. Doesn't really work out. They sell Medco or spin it out in 03. Lilly and SmithKline Beecham both took 60 and 70% losses in 1998. They just got out of the business immediately, and that closed Chapter 2. Chapter 3 is, would you like to save yourself some money? So remember, in Chapter 1, it's a one-tier formulary, two-tier formulary. If you get a brand, it's the same copay whether it's preferred or not. These green columns are the percentage of employer-sponsored beneficiaries that are in either 3 or 4-tier drug benefit designs. So what that means is there's a difference in out-of-pocket costs between the preferred brand and the non-preferred brand. This really starts to matter. So as brand executives, we start to feel that there's really brand preference being created by PBMs, and they're also having an impact on unit volumes because patients really do want to save themselves money. So when they show at the prescription counter, there used to maybe a $20 out-of-pocket, they get a $35. Pharmacist says, hey, if you take this other brand, it's going to be a $20. Do you want it? Patient says yes. So you get a lot of switching. As a brand manager, the way this felt, the wave that was coming at you was the expansion of enrollment, right? It was more and more people going from fee-for-service to managed care and going into these 3 and 4-tier benefit structures. What it was not, let's go to the next slide, was a change in the copay. This x-axis is almost a quarter century long. And you've got the dollar amount of the Tier 1, Tier 2, Tier 3, Tier 4 copays, the lowest, obviously from low to high. Now, these are deflated to year $2,000, but the copays never go up, right? Once you put these people in 3 and 4-tier copay structures, the copays just stay the same in economic terms or real terms. And the reason is the plan sponsors want these drugs to be affordable. But you as a PBM, you need to grow leverage in order to grow rebates, grow your fees, right? You're a publicly traded entity. You care about your stock price. You care about your cost of access to capital. So you're asking for bigger and bigger rebates, even though the copays are staying static in real terms. So it sets up this situation. So the red line is the rebate that you as a brand manager are paying, and the blue line is the number of dollars it saves your patient at the pharmacy counter. So here, let's just look at the extremes. In the extreme left, 2002, you're giving a $17 rebate, and it's making the drug $22 cheaper at pharmacy to the patients. Pretty good deal, right? Your only other option would be to give the patient a $22 coupon. Why would you do that when you could just pay a $17 rebate and be the preferred brand? So we're all paying rebates, and we as manufacturers are not even thinking about copay cards or coupons. When you go to the extreme right, we're now being asked to give up a $52 rebate in order to save the patient $36 at pharmacy. Doesn't really make a lot of sense, right? So we start thinking, hey, I just give this guy a $36 coupon and I'm going to save money. And that's how copay cards came about. Now, if you're a PBM, this really bites hard, right? Because you're not getting rebate growth, and you need rebate growth for cash flow growth, earnings growth, good share price, and low cost access to capital. So the graphic here on the right just shows the expansion of copay cards. So halfway through 2009, we had almost 100 brands of copay cards. In 2008, we had almost none. By the end of 2011, we had almost 400. And literally every brand today filled at retail, unless it's purely Part D, is going to have a copay card that goes along with it. That is the turning point of the relationship between PBMs and brand manufacturers, the emergence of copay cards, and the 2 adaptations from PBMs that came afterward have really defined pricing sense. Adaptation number 1, we call musical chairs. It's formulary exclusions. And the way that works, and this era goes from 1Q14 to now, it's just musical chairs, right? So if there are 3 drugs approved by FDA for the indication, I'm just going to cover 1. And the reason that fights back against copay cards is for my copay card to work as a brand manager, you got to let me on tier 3, right? I pay you the little rebate just to get on the formulary to be on tier 3, but then I pay you a real big rebate to be the preferred on tier 2. So the fact that you're letting me hang out on tier 3 enables me to use copay cards. So what you do is you just shut that down and say, I'm just going to have you a preferred tier. There's still a non-preferred tier for some brands, but if you want to be in this category on my formulary, you have to be the preferred brand. Best foot forward, we're just taking one. And so the graphic on the left shows the average net price within a category for 8 categories indexed to 1 in the quarter before formulary exclusions were applied to that category. And you see the rate of decline. It's about a mid-teens rate of decline. But look at the x-axis. It's 28 quarters long. I've got one that's 36 quarters long. I couldn't find it this morning. That's enough time to get your high school senior through med school, right? So you're seeing a 15% decline in this category, and it goes on relentlessly. So as more categories are placed under formulary exclusions, it begins to weigh very heavily on the total industry net price trend. The other thing these exclusions have done is not only, and this is the long-acting insulin, sort of a drill down into that category, you see the characteristic net price decline, sort of mid-teens, multiple years, but the other thing you see is price compression, right? So you have these categories that have fairly broadly varied prices. You put them under exclusions, not only do the prices fall, they all kind of find the same place. So quick sidebar, you think about the IRA, 6 of those 10 drugs that were selected are in categories that are under exclusions. One of the negotiating mechanisms is comparative effectiveness. So when CMS goes to look at the other drugs that are substitutes for the drug that's been selected for negotiation to use those as a benchmark for the price, they're going to find that these drugs all have the same price. Another feature of exclusions, Tresiba is meaningfully differentiated versus the other products on this chart. But if you look at what happens to its price over time, it just gets caught in that air pocket, right? So traditionally, before exclusions, when you came out with an innovative product that was meaningfully differentiated versus the competitors in that category, you could expect to establish and maintain a premium. You can't really do that anymore. So this has important implications for R&D returns, which are a little bit outside of our immediate scope here. And then finally, chapter 6, copay accumulators, maximizers, optimizers, things like that. So the way these work are, they're basically copay card counter strategies that work at the point of sale at pharmacies. So if I was a brand manufacturer, give you a copay card, it's going to give you enough subsidy to get your out-of-pocket down to a targeted level. Now, if your copay is 100 and I want your copay to be 20, my card's going to give you an 80. But if your copay is 500 and I want it to be 20, my card's going to give you 480. My card's also going to have an annual limit on it. Most manufacturers, as a brand manager, you'll see your copay cards, maybe 2 or 3% of them will hit the annual limit in the fourth quarter. Really tiny, right? They almost never hit the limit. In the first quarter of 2018, our phone is ringing off the hook. We've got panic clients saying, I've got 10, 20, 30% of my copay cards hitting the limit in the first quarter. So what was happening is PBMs are basically artificially in that transaction space, the NCPDP switch, setting, when they saw that copay card coming, even though your copay was really 100, they kind of set it to 500 or 1,000 and just extract as much credit from that card as they could. Now, if you look at the graphic, let me see if I can, within that circle. So that black line is net price. That's the whole market. You see the rate of net price change, decline since 1Q18. The green line is the basket of products that were hit by accumulators. The gray line is the basket of products that were not. So what this slide proves is that all of that pricing action in sort of 2018, 2019 was driven by this point of sale game, this tug of war over copays. Now, this particular reaction to copay cards has pretty much been put back in a box. What manufacturers are doing is they're taking that copay support out of line of sight of the pharmacy, more of an indemnity structure, so that copay support is still there, but the PBMs aren't capturing it. Let's wrap this up and just sort of look at these chapters or these key events against the backdrop of the actual price trends. So this green line is going to be the rate of change in list price. The solid green line is list. The dotted green line is going to be net price, 2008 to current, and you see sort of the major extremes and most recent values marked here. Copay cards start at the beginning of the graphic. It's tempting to say, and I don't want to wade into the argument of do copay cards allow higher prices or not. I think the answer is yes. You see price inflation after copay cards start. that wasn't what happened. Copay cards can lead to higher prices, but this inflation, remember Valiant? Valiant was buying products that were not aggressively priced, buying companies of products that were not aggressively priced, pulling them into their portfolio, really raising prices aggressively, getting away with it. And it's a lot like driving on the interstate, right? If it's really busy and you're going maybe 5 over the speed limit, you think you're okay. If you're really in a hurry, you go maybe 9 over, you think you're okay. If everybody sees a cop on the hill, everybody slows down to the speed limit or below. But sometimes everybody's going 20 over or 30 over, and you just tuck right in and go with it. And that was that era going into 2013 or 2014. Everybody's prices are moving quickly. Nobody wanted to be left behind. Exclusion started in the midst of that, right? So it was not just a reaction to copay cards, it was also a reaction to hyperinflation. And you see the deflation that followed. Remember, we said when you hit a category with an exclusion, you tip it into a negative mid-teens rate of net price decline for eons. And as you add more of these every quarter, every 2 quarters to your portfolio, you begin to bring the whole net price trend down, which is what has happened. And then we have this blip here where the accumulators hit briefly in 2018 and 2019. And that first quarter of 2018, this is a 4-quarter rolling average, but if you look at 1Q18, that was the largest net price decline in the industry's history. That was the quarter that copay card accumulators sort of came through as a surprise. Final slide, discount rates. Again, 2008 to the far left, the black line is the total industry average discount rate. It sits at 25.9% where the slide starts, ends at 51. Right, the manufacturers are now keeping 49 cents on the gross sales dollar. We threw in a few categories just as examples, diabetes categories here in the top. You see on the left of the graphic, they actually have subnormal discounts, right? But at the end of this game, they're discounting 80 plus 90%. These are categories that were hit by exclusions. And then you see you have some outliers on the bottom. These are protected classes, right? Multiple sclerosis, oncology kinase inhibitors, et cetera. So on balance, this industry has not, and I'm not here lobbying for the industry, I'm just showing you the data. We have not seen net price growth since the first quarter of 2018, and we will not see it this year. It is because primarily of formulary exclusions. And it hits the industry average, but it doesn't hit evenly. If you're a category that's hit with an exclusion, that's bad news for you, whether you're an incumbent, whether you're an innovator coming newly into that category. Those targeted categories have borne the brunt of the losses. So I'm going to stop there just in the interest of time. Don't know if you want to take questions or we can
do we have
do after.
questions from, if we have time for a couple questions, if anyone has any questions. Yeah, they exclude, oh, yeah, we have one over there.
So how do you think about, I mean, people talk about with the net price trends, there's all this other stuff going on, like 340Bs growing, there's the Medicaid rebates
Yeah.
in there. Do you just sort of think that's sort of broadly consistent, a sliver of this? Or
No, it's a big part. I think 340B is at least as big as Medicaid right now and probably larger.
and do you think that's meaningfully changed over that last slide you had?
It is.
That acceleration?
It is, yeah, but it's kind of come in a little bit more evenly, right? So if you look at just one way to proxy that is just the number of 340B pharmacies and things like that. So yeah, it has absolutely cooled the temperature in the room on drug price, no doubt about it. It shifted more of your portfolio from sort of commercial type discounts to Medicaid 340B type discounts. It's definitely been a big headwind. Mathematically, the biggest effect is the formulary exclusion. The second largest effect mathematically is actually biosimilar competition. Because it hits some really big categories, right? And that's actually the reason we won't see net price growth this year. If we didn't have biosimilar adalimumab, we probably would, right? Everybody outside of Humira and products that share indications with Humira probably would see a little bit of net price growth. But just that one biosimilar will keep the whole market negative.
Have you done any analysis of the impact of net price growth in particular categories of drugs on investment in innovation?
No, we haven't. We do have a corresponding data set where we use patent data to track what manufacturers are currently doing. We haven't tried to do that analysis. I can tell you as a former portfolio manager for Roche, responsible for choosing products that get developed in the future. You absolutely care about this, right? So you're definitely looking at price trends. The IRA probably is what looms largest right now. We saw the 10 drugs that were selected. 7 of those drugs already have discounts below the statutory minimum, unlikely to yield a lot of savings. prescriptions because IRA is choosing those drugs based on gross sales, not net sales. In Part B, they're choosing based on net sales. So those negotiated drugs are going to lose price. So as we look at that strategically, it looks like IRA bites really hard on the Part B side, but not so hard on the Part D side. So that implies a preference toward retail. And the IRA in general is implying a preference away from drugs for the aged and towards drugs for people of working age or younger. But I can't support that empirically, but I would argue that that's the trend.
Just one last question in the back.
Yep.
Yep.
So with respect to that gross to net bubble, of growing the differential between the list prices and the net pricing, can you just comment on if pharma is not making any more money in the net, then why is that information not being made more public, granular, like to the NDC level, so that patients that are being asked to pay out-of-pocket prices that are in excess of what pharma is actually receiving
Yep.
for the product? Would pharma ever participate in making that information public so that we can put a regulation in place such that patients should never be asked to pay more for a drug than pharma is actually receiving?
Yeah. Scott Gottlieb, when he was FDA commissioner, felt pretty strongly about getting rebates to the point of sale, which is kind of the same thing, right? So you're getting that dollar concession, putting it at the point of sale. I actually agree with that. I think it's woefully unfair, for someone who's sick to pay a full burden that marginally reduces premiums for everybody else. So I absolutely support that. I think manufacturers would support that as well. And in fact, they do formally support that. And not to point fingers, but in a game theory construct, it's really the plan sponsor. I mean, the intermediary, the PBM, doesn't want to do that because it puts the rebate in plain view. You can't retain as much. But the plan sponsor could do that today, right? So Andrew Whitty at Optum and others have logically said, look, if the plan sponsors wanted to do that, we could flip a switch and do it tomorrow. In fact, they offer those plans, but the sponsors don't pick them up. I do think it should go that way, but it's more about the employer sponsor, I think.
We got one last question.
I don't know. I really don't. I think it's probably the same reason that Part D bill failed, right? That was going to drive rebates to the point of sale. When CBO did the math and showed what that would mean for premiums, the Hill just walked away from it, right? Because you would have to sell premium growth to everybody versus out-of-pocket savings to a small group. My guess is that that's where plan sponsors are as well. But I don't know. It just seems to be an element of fairness that's not part of the discussion.
Yeah,
Thank you so much.
All right, thanks, guys.